Welcome to the Broken Pie Chart Podcast, episode 148. I'm your host, Derek Moore, and this week back on the podcast after a 2-week hiatus is my semi-permanent co-host, Jay Pestrichelli. Jay, how you doing today?
Good, Derek. Good, Derek. As always, glad to be back. Love the podcast.
Yeah, well, I was getting a little jealous. You're doing CNBC and Cheddar TV, and I said, I hope you have time for us, this little people here on the Broken Pie Chart Podcast today.
Always have time. Always have time. We could really dig deep on the podcast where they give you, 90-second clips to explain your entire investment philosophy to the public, right? So this is great.
Yeah, we could do a whole separate podcast about going on TV and all that stuff. I will mention for the listeners,
got quite the experience there, Derek, right? You've done a lot of media as well.
Yeah, and I, here's a little inside baseball. I think it's interesting with the, usually if you're doing a remote, you have the IVR in your ear, and you can't see. And if there are other people talking, you know how difficult that is. But you were saying with Skype, it's actually a little bit different where you can see the people, and so that's a little different medium, right?
Yeah, no, it's very different, right? Pre-COVID, it was in studio, or you're right, you just had to stare at a camera and you had a light in your face, and that was it. Now you get to see who's on the other side. You get to see the graphics that they put up on the screen, and you're doing everything out of your home office or from your work office, either one. And so it is very different. And I even offered, hey, I'll come to the studio. They're like, yeah, no, we don't want people in the studio. They're really enjoying the Skype. Skype is the preferred app that they use. Props to Microsoft there, but it's definitely interesting how that channel is migrated. And I think their producers are separate from the people in studio. I think they're all over the place. It's just a little different world.
Yeah, no, I agree. And it's the in studio thing, obviously with COVID. I mean, what is it? Isn't it Kramer and then Carl Quintanilla? Didn't they say, was it yesterday? They're both remote now because they have COVID, and David Faber was in studio because he was traveling, right?
Yep. Yeah, they are. They're remote. Yeah, I think Kramer's got COVID right now. Like that's what he was talking about. But he's doing the show from home. It sounds like he feels fine. Seems like that's the spiel these days for most people. I'll add that the media experience has definitely changed. You get a lot more. I'm going to say clowns. That's probably not fair to say, but you get a lot more oopsies when you're doing it remotely. Like I had my internet crash on me, 2 minutes before I went onto a Fox spot, and I had to quick launch Skype from my phone, right? So you've got stuff like that happens. So sometimes people have a bad microphone, bad lighting. Like the quality of the interviews starts to get a little distracting versus what it used to be in studio.
Yeah, I'd agree. I think the last time I did it in studio, obviously they have the lighting. I mean, you know how it goes when you show up. You show up, and depending upon who else is a guest on whatever it is you're going to be on. Last time I was on, I think one of the news channels, and my segment was last. So they have all sorts of people going first, but you have a producer and you have a mic person, a technician. They check things. So yeah, it'd be they tried not to let you fail, but I mean, think about everyone at home. I mean, it's like, all right, you got to do lighting and the camera and the mic all yourself. So
yeah, like you're doing your own stuff. I will tell you the best one of all the studios I've gone to by far is Bloomberg, by far. So Bloomberg actually has like a salon in the building where like you go, they'll fix your hair, they'll do your makeup, right? They do everything for you. They got a great green room. Bloomberg is definitely, if I had to pick any place, from the facility perspective, Bloomberg is definitely the best.
I will tell you, because I don't have hair and I shave my head, and if I didn't shave my head, I would still not have hair, except for, certainly not on top. But I do remember last time I was in, I sat down in the makeup chair and they did makeup, and the woman said, "Oh, I'm going to be quick. Get to be quick with you because I don't have to do hair." So yeah, they just did makeup.
But didn't they have to put like the no shine all over your head, right?
Oh, they did. Yeah, they did. But I don't really sweat. No. So here's the thing: even when now they use LED lights a lot, but in the old days it was really hot lights. I never really sweat too much. So that's the thing. If you sweat, they got to come up on like a commercial break or before you go on and sort of blot your head with this powder. But anyway, so maybe that's another podcast altogether. Certainly not not one we'll be involved in on makeup tips for TV. But
Right,
what
right.
we
There's
do,
probably a whole different podcast for that.
all right. So hopefully the three people still listening are still with us. Is we're going to talk about predictions for 2022. Yes. And by the way, just if you're listening to this and you listened to last week's, I started last week's show saying it was episode 148. It was 147. So I sort of opened the show the same, but I never do edits on these, so I just left it in. So if you're listening 2 weeks
Counting
in a
is
row,
usually your strong suit, Derek. Like count, you could count.
yeah,
You're good with the math stuff.
I
I
was
bet.
I don't know why I was thinking which one it is, but we're going to go over predictions, and I say predictions loosely because you and I have both said time and time again, we don't trade the markets, we don't invest money for people, we don't run portfolios based upon making guesses or making predictions about market direction for by and large. We get invested, we hedge, we think that's the way to do it. And we don't know when the best days, the worst days are going to be, but over the long, term, if you can get a buffer in a portfolio or put a floor under a portfolio, it does take a lot of the guesswork and the timing out. But we do talk about the markets. And we did something this year where you and I, and then some members of the investment committee, just threw together some predictions. And I would say that you shouldn't trade off these. Nobody should trade off these, not even us.
Definitely not.
But I think it would be helpful, just to kind of go through the way we think about things and the way we read things and the information that we use to sort of come up with an output. And so that's what we're doing. So when we say predictions, it's not a recommendation by any means. But Jay, I'll sort of start with you, and maybe which one do you want to start with? Do you want to do the market first? Do you want to go there?
Well, I think that's one everybody wants to hear about first, right? What do you guys think the stock market's going to do? That's probably the first one.
All right, Jay. So
And
go ahead. Let's
I-
start
I'll,
there
I'll,
and
I'll
let you
kick
run.
it in. Well, I first off, you've said this time and time again, Derek, is we could make bold headline grabbing predictions, right? We could talk about a 50% sell off around the corner, but that's not what we are, right? We think using maybe a more measured approach, maybe even a boring approach when it comes to this kind of forecasting, predicting. Is probably more prudent, right? We're not trying to create excitement in your portfolios and trying to get fast moving money bouncing around between different one off thoughts, right? We are more of I'll say, an even measured hand when it comes to this type of stuff. So for when I take a look at where the stock market is going to go, next year I think topping out in the 5,000 range on the S&P 500, which is about, I don't know, 12% up from 10, 12% up from where we are today. I'll let you give your number in a moment, Derek. But what I would say is on average, this is kind of slightly below where the team is coming in. But me, I'm in that 5,000 range.
Yeah, let me see where I was. I here I'm thinking I was a lot different. I was 5,020 is what I had. Now this is the year end, so it's not to say it can't go higher or lower from there. And you're right, Jay. I mean, I won't name anybody, but if you look at, like, let's say Yahoo, and you look at some crazy predictions, maybe it's doom and gloom and we're going to crash 75, 80%. And then you use that person's name and you go to Google and you change the years, you change it to, let's say, 2015 or 2016 or 2017. A lot of them were making the same predictions and they never came true. So that's right. I mean, if you want to make a crazy prediction and if it happens, then you write a book about it.
I was going to add here, Derek. When we put this together, it was about a week, 2 weeks ago, right?
Yeah.
Maybe some. The market was down 5% then from where it is today. So believe it or not, you and I are actually about halfway already to our end of 2022 predictions based off when we put this together in early December.
Oh, that's right. That's a good point. Yeah.
We may need to revise these up a little bit, right? Because we're going for, Jan to December kind of a number. So they may need a little revision on this. But that's, anyway, just thought I'd clarify because I said 10 to 12%. And that's where it was at the time we made the predictions.
Yeah, I think I was around the same, that 11 and 12%. Now, I went back and we've talked about this before, looking at data from 1928 forward. And the average, just the average, not the compounded annual growth rate, but the average annual return is about 11.64%. So I'm kind of like, there's a 50% probability that that's what we would get. And I think in general, I mean, and we'll get into corporate profits, but there's a couple things here. I mean, corporate profits have been good, net margins have been good. But Jay, I mean, my answer is not really a groundbreaking answer. It's, you know what, I think we'll get the average next year. But I think both of us are constructively bullish on the market, right?
Fair enough. Yep. Actually, everybody on our investment committee was bullish, some more than others.
Yep, I would agree. It's, by the way, I don't know if you've seen now the some of the ones that I've seen that have come out. I think it was Vanguard. I'm pretty sure it was Vanguard, and they released sort of their average annualized returns for bonds and for stocks. What they will average over the next 10 years. And I don't think it's just Vanguard. There are some firms out there who are predicting, much lower, like maybe 4% annualized growth rates. And that's different than just 2022. But I feel like the markets have outperformed. I've seen those types of predictions before. I don't know if you've noticed that as well, Jay.
Yeah, no, I have, and but I think we're in a different environment today, which will lead me maybe to the next data point we could talk about. You and I both believe a lot of the drivers of where the market is right now and where we think it will go is earnings per share, right? And I think so. We're in a little different world from the historical predictions. We've got the low interest rate environment, we've got higher corporate profits, and so maybe we rotate to that one next, Derek.
Yeah, I think that's a good spot to go to. And after we talk about corporate profits, I think I want to get into sort of the COVID relationship and then maybe historically what's happened out of those time periods. But corporate profits, we look at those on a per share basis. So just like there's earnings per share on a stock, there's earnings per share on the S&P 500. So Jay, you can start again on this one too. So what's your
Yeah, I came in at the high end of the bunch. By the way, I think it was episode 145, Derek. We talked about earnings per share on the S&P, what that dollar amount made. Look at me,
Yep.
I'm referencing back your episodes.
Smart.
I feel like I'm really becoming part of the team here.
Well, you are. You've I think you committed to 40 weeks next year, right, Jay? Is that right?
40 weeks minimum contractually. So look, for me, I end up coming on the high side, right? I think with inflation, it's going to push corporate earnings. It seems to me companies have had a lot of pricing power, and I come in at the high end at 250 per share on that, or on earnings on the S&P. You're a little lower.
I am lower, and I think I'll tell you, mine is 231 on the S&P. And let's kind of break that down a little bit. And actually, do I have it handy? Yeah, I do. I just want to give what the street estimates are for 2022. I'm just pulling this up. I think I have it handy. Yeah. So I think the street estimate. So when I say street estimate, it means taking all the analysts that are covering the S&P, and I think it's 222.85. So I'm pretty much. Am I?
I mean,
Yeah.
you're still above
No.
the street by next year,
Yeah, I'm
5%.
above the street, and I will say that those estimates are revised all the time. And Jay, one of the things we've seen is the EPS estimates keep getting raised, and historically, they don't always get raised. A lot of times they get lowered. But I mean, you said it on both CNBC and Cheddar TV that earnings have been beating the estimates, right?
They continue to beat the analyst estimates. Yeah. I mean, all year we've seen that. I mean, last quarter, wow, very strong when it came to return earnings. So, yeah, that is part of the reason why I think you and I are above where the analysts are. And I, like I said, I think inflation is going to help push us to kind of ranges that, no one's really thinking about.
The other thing too is, so your estimate imputes, I think is the word, and you know where I'm going with this, a 20 PE. So that would be a trailing at the end of the year. full year 2022, if the market's at 5,000 and EPS is at 250, you would be at a trailing 12 months 20 PEJ. So probably a little above the, what is it, the 16 average? Is that right? I'd have to double check that.
Yep. And it's actually a little lower than where we're tracking even today, though.
Right, because forwards are, what are we, 21, 22 on a forward
Yep.
basis right now?
In that range. Yep, exactly.
And so what that would mean is you would see, I'm trying to think from a multiple standpoint, whether multiples would expand or whether, no, I think EPS would drive most of the change in the market, right?
Yeah, it would be another a year of multiple contraction like this year. I know we've talked about that in the past, where EPS was driving more of the growth. Now, I think you're coming in at about a 21 PE, closer to where we are trading right now, right? So you're slightly higher on the S&P, but a little less than I am on the EPS number. So you're coming in at the 21 EPS, sorry, price to earnings ratio. I'm coming in at a 20. You know, I guess we could kind of dig into that a little bit, but you know, why don't you pick up why that's an important number to a lot of fundamental investors?
Yeah, I mean, this gets back to valuation. So historically, there's two things you hear quoted on TV. Number one is, we're trading at a forward something X PE, meaning the analyst expectations over the next 4 quarters, and what's the price of a stock or an index right now. And the idea is the higher the multiple, the higher investors are placing, on a value basis. And so what happens is people come in, they say, okay, the market's overvalued because it's trading at so many times next year's earnings or forward, 1 year earnings. And people try and, time the market a little bit on that. And so and then you also have the CAPE ratio, which is Shiller's ratio, where they look at 10 years and they do some averages and things like that. But I think that it's important. And also you mentioned the multiple versus um, whether it's earnings. And I did a show last week, Jay. I'm sorry you missed that one. But if people want to listen to that, where I actually deconstructed all of this. So, we'll kind of go over it a little bit quicker. But you could have price go higher and earnings stay the same, or you could have price go higher and earnings go higher. And so, I don't know about you, Jay, but I feel like we could be trading at a higher multiple for longer. We'll get into interest rates, and I'm sort of lower for longer there, but I kind of feel like higher multiple for longer. What do you say?
Absolutely, couldn't agree with you more. For those fundamental analysts that'll say the market's historically expensive, I would reply to them, yeah, interest rates are historically low. They're not in a vacuum. You can't take earnings per share in a vacuum because of you need to look at the entire environment. And so, even though everyone said the market is expensive and there's been a little contraction in the multiple, earnings continue to push the market higher. I don't think anybody sees a slowdown in that. I mean, that is what the whole, the fear days that we've had when the market goes down on let's say COVID fears, for example, is, oh, maybe the economy won't be as strong. But I'm with you, Derek. We should expect a higher multiple, a higher PE ratio in today's environment than what has been used as kind of the historical average.
I think that transitions to, a point I was going to bring up. And you and I read a lot of stuff. We watch a lot of stuff. And we said before, I mean, we don't get into the COVID thing on the humanitarian side, or neither of us is a virologist or a doctor, although I have watched ER, as I have joked about in the past. But, I looked at the 1918 pandemic, and I sort of traced the time it was a problem. And then I looked at the retracement in the market and then what markets did afterwards. And what you find is, I think, and this is uh, some research I did, it looks like around February of 1918 is sort of when this all kicks off. And by April of 1920, it pretty much burned itself out. There was this last spike in New York City, but after that. And this started, I mean, February, March, but let's call it, around February of March. I'm not talking about, theoretically when the first cases were. So if you trace that time frame of the 18 pandemic over the 2020, the current one, that says around May 1st. So I don't know if that's a hopeful thing. Maybe this thing, because the other one, I guess, wound up degrading, how it mutated, and then it wound up being just, more of a common flu. It'd be great news if this sort of gets down to the fact that people get it and it's just, kind of like having the flu. But what's interesting, Jay, is that the market only retraced 10%. And I'm talking about the Dow Jones I looked at. We retraced 37% in February and March. But after the pandemic wrapped up, you had a massive bull market from, that didn't end until 1929. That's a whole different story about what happened then. So I don't know, Jay. I mean, is this a situation where if this can, sort of get behind us, we see an explosion in the markets again? And I'm not giving a buy signal at all, but I just think it's interesting to look at the
Yeah,
past.
look, I think it's interesting. I think the markets have evolved quite a bit in the last 100 years, Derek. I think the speed of the markets is something that would accelerate any of that. I feel we've probably already seen some of that recovery. If we're going to use the pattern that we're going to follow, I think we've seen a lot of that in the markets already. It is interesting, during that period, to think about where rates were as well, right? And I think you have a little insight there. To me, the market recovery, it'd be great if we followed that pattern of the years following the last pandemic. But again, like I said, I think this is a good one for us to, for me at least, to take with a little bit of salt, just because of the different mechanics of today's market versus say 100 years ago.
I mean, it was the quickest trough back over the prior peak we've ever seen in a recession, right? I
It
think
was.
that's,
It was.
yeah.
Yep. Yep.
I mean, it's
Yeah.
still, I mean, just thinking back, and that seems like 10 years ago, but that was only less than 2 years ago that all happened. So, yeah, I think you're right, Jay. I mean, the speed of it, and then of course the Fed coming in and, I mean, buying corporate bonds and, buying ETFs and putting interest rates at zero. And that's the other thing too. I was watching a podcast from some of the CNBC crew, and Tom Lee was on there. Tom Lee is a frequent guest on CNBC. One of your fellow, uh, CNBC contributors. Actually, I don't want to be. I have to be factual. I guess a contributor is a specific thing, but you're a guest on there.
There you go.
But he,
There you
yeah,
go.
but he said he had this chart, and basically what he said was when you have negative real rates, so that is the 10-year Treasury rate minus CPI, and I think he used core CPI. When that's negative, stocks do really well, and we're actually in a negative period now. And there were other factors, Jay, but I mean, um, the market did really well up to that 1929. That was a period of negative real rates. You're talking about the early 20s, late teens. After 1941, so you had World War I, World War II, and those are the last times you had these extended periods of negative real rates. And we have it now. And I don't know, Jay. I mean, I just thought he brought it up and I said, that's interesting. So I figured I'd bring it up. But negative real rates,
What are you going to do in this situation, right? Invest in a vehicle that you know is going to yield you a negative return for the next 10 years. It's not the way the average investor is going to invest because they need growth, right? So I mean, I know we've talked about it, and we always say interest rates are one of the things that drives the market. It's because of that. When you can't get paid for the risk you're taking in the bond market, you've got no choice but to put money into the stock market. And so I think it makes a ton of sense. I think it's the thing that's driven the market as high as it's gone. I think it's the thing that pushes us to new highs going forward, right? There is no alternative. And so you have to go into stocks, right? And so that's look, this is I've probably beat this drum way too often, way too much. But when I think about logistically what makes common sense. By the way, common sense does not always work in the markets. I can give a lot of examples where common sense didn't pan out. But in this scenario, guys like you and I, advisors that are forced to help our clients meet their financial goals, we can't deliver on our job by putting people into treasuries, right? There may be one or two pieces in the fixed income category that we could use, and we'll probably talk about that a little later. But in general, investment grade bonds, treasuries, what we consider the safe harbor assets of the fixed income market, you can't put anybody in there that needs to deliver growth. You just can't.
Yeah, no, I think that's right. And before I transition, because I do want to go to fixed income next, but a thought came into my head that I thought I'd bring up. This pandemic has brought forward a lot of, I'll say, productivity gains, technological gains. You started out talking about how you didn't have to fly to New York and go to the studio for CNBC or Cheddar. They're both in Lower Manhattan. The
Sure,
exchanges,
sure. Right. I mean,
both of them.
we've definitely drawn forward some technical advancements. I mean, this is nothing new, right? We're not saying something shocking. The world has been saying this now for
No,
over a year, right? But I think you're right. I think it's improved productivity, and I think it's also, just changed where your dollars get spent as you're, running a business or any kind of corporate expenditure. It's just changed where the dollars have moved.
Jay. There's a book too that I read a couple years ago. It's called Technological Revolutions in Financial Capital: Dynamics of Bubbles and Golden Ages. And that book it's kind of interesting. And
It's a thriller, right? It's a dramatic
have
thriller.
you
Is
read
that?
it?
No, I haven't. I was just teasing
No,
you about
well,
it.
you should. You should. No, but it's really it was written, I think, in the early 2000s. But the book is all about this whole idea of when you have these technological revolutions. It's the early companies. The standards aren't set. Like you think about the internet, like all these companies did different stuff, but those aren't necessarily the people who are around. But the technology gets adopted, and it's sort of the older line companies that benefit. Like Domino's benefits from the internet and having an app and cloud computing and all that stuff. They're a pizza company. So it made me think. I'll put it in the show notes. But it's the idea of when you have these technological advances, sort of who provides those, and the winners and losers, come and go, and there's some people who blow up. But it's all these companies get to benefit from that, and that can sort of issue in this new age. But yeah, I'll put it in the show notes, Jay, if you haven't read it. But
Yeah. But I mean, there's Nobel Prize winners that have prize winners that have spoken about this topic specifically, right? And so this is just one of those things. As we advance, you just see a shift there, and you're trying to make your workforce as productive as possible. It is not a new story; it's an old story. Hey, let's. I think we should probably. We're at the 28-minute mark, man. Let's get into the rest of these. We got more to do.
well, let me. So what's going to happen with rates? Let's go right there.
Yeah, let's go right there. You and I are definitely on different spectrums. I'm on the high end. I've got us hitting maybe 2.5%, where we end the year on the 10-year, which is fairly high. And I think we actually peak out at even 3.5, and maybe have a low of 1.5. So I'm this plus or minus 1% on the 10-year, with 2.5 being kind of the end of year number.
Yeah, you're higher than me. I have high of 1.7. We're talking about the 10-year Treasury rate. High of 1.7, low of 1.28%, and end of year 1.47%. Is that literally like where we are today? I'd have to check, but
I think
uh,
that I'll look right
it's
now.
one. Yeah, 1.45 is where we are.
1.478. Actually, I'm looking at 1. Oh yeah, right, 1.457. So you're right there. You're right there.
Yeah, so it's sort of yeah. Look, I mean, I'm lower for longer. I've been on low rates for a long time, and I actually think we could see low rates for much longer than people think. My thesis here is number one is there's a lot of demand for treasuries. The spread between, let's say, what German bonds are yielding and some of the other countries' debt, and it's uh, I could see a case where the Fed, we have inflation, but the Fed keeps rates relatively low. But you're higher. I mean, I think you're anticipating, due to some Federal Reserve moves, maybe the rates have to trickle up, right?
Yeah, that's it, right? I'm following along with where the Fed is expected to raise rates 3 times next year. And I'm also following along with kind of future growth, right? Rates tend to go a little higher as growth is, as you can see, growth in the future. But you've got some interesting dynamics on your side, Derek, which is, I think, why, I think if I gave you 2 or 3 years, you'd probably press a little higher on this number. But why you're more subdued, and actually, I think you're the lowest on the investment committee here, why your perspective about what's happened going into tapers and Fed raises, what's happened in the year that those have occurred. So maybe you want to expand a little on that, on why you're so low.
Yeah, Jay. I mean, I think when you look at the past taper, and the big one I'm talking about is the Ben Bernanke years, and rates rallied in anticipation on the rumors that the Fed would do some sort of tapering. And by tapering, of course, that means paring back their bond buys, maybe eventually selling off some bonds and reducing the balance sheet, and then raising rates. The hint of it, rates rose when they actually announced they would start to do it. I think it was 2014 or so, 2015, around there. I don't have the chart in front of me. Rates went down, and even after they did their first raise of 25 basis points, rates went down after that. So for me, I look at that. I also look at what the Fed is, and I've talked about this quite a bit, so I won't get into it. But the overnight reverse repo market, they're over 1.5 trillion. The low end, there's so much demand at those auctions for the near duration treasuries. So I look at sort of the dynamics on that. Jay, you've looked at that too, and you pointed out that the market has pulled back, and you've had this flight to safety as one of the reasons why. And so here I am, I'm net bullish on next year. But yeah, I feel like the dynamics below the surface are such that rates can remain low.
Yeah, and actually, as you're talking about the Fed and the Fed having to take action, maybe that can lead us into our next point, which I think is the obvious easy one, which is inflation. Right? Maybe we'll hit the inflation projections, because that seems to be a hot topic for everybody right now. Certainly in the media, everyone wants to hear, where is inflation going to be? Is this temporary? Is this transitory? Is it going to last for longer? You want to kind of walk us through the inflation number?
Yeah, and everyone should grab a pen and paper, because I'm going to give you the exact correct inflation rate for 2022. Here it is. Grab your pen. No, I mean I'm at 5.1, and I think we'll see inflation remain elevated, but we're going to start to get into an issue where it's denominator numerator type deal, where the comparables, as you keep going back, as we have higher and higher prices, it gets a little more difficult. But yeah, I'm about 5.1, and I think you're lower, right?
I mean, not much lower. You're the highest on the investment committee at 5.1. I'm right behind you, or second place at 4%, which I think lines up a little closer to my interest rate, my 10-year projection. But I do think it's interesting, Derek, that you're the highest on inflation, but lowest on the 10-year. And I think that goes to that data you just talked about, that, hey, look, even though the Fed will be raising rates to fight inflation if they have to, that doesn't necessarily translate to what the market actually ends up yielding. But yep, we're close. You and I are number 1 and 2 when it comes to inflation. We've got one of our guys at 1%. He really sees a slowdown in inflation, and that's
Yeah, I think he's numerator denominator. Is
yeah, yeah, yeah.
his. The other thing
Listen,
is,
large numbers, right? It's harder to create
yeah,
that inflation once you've had this big increase that we're having in 2021.
the other thing too is, and this goes back to why I'm lower on rates. I'm not sure if raising rates will actually impact inflation. I think there's a lot of other. I mean, you made we've had pandemics before in 19, but those are in 1918. Like, do we really know that rates being raised will curb inflation, or is it all the supply chain stuff that you and I have been talking about? Is it
Well,
Is it
well, we've had
COVID?
inflation.
Yeah.
We've definitely had inflation, but more recent than 100 years ago. Obviously, I know you weren't insinuating that, but when you think about why the Fed raises rates, right? What are they trying to do? Right? Is usually it's to cool the economy a little bit, and one of the ways that could the a reflection of a strong economy can be inflation. Now, it hasn't been for a long, long time that we've at least 20 or 25 years, right? So that we haven't seen any kind of real inflation in the U.S. market. And so, it's. I think you're right when you say it's hard to know, what raising rates will actually do to this inflation that we have today, which is more and more becoming evident that it's a supply driven inflation number, not a demand driven inflation number. And those are different factors that push inflation higher.
Yeah. The other thing we haven't talked about is, and I think Spencer and I will do a way too early election prediction show, maybe in the first quarter of the year. But we got midterms coming up, and although the Fed is non-political, um, you never know behind the scenes what type of pressure or influence that can have. So I don't know. I don't know. But we do have midterms next year, which is actually something we didn't. I don't even know if we discussed that back when we did these predictions. I wasn't really thinking of it too much, but other people have brought it up, Jay. I don't know if you have any quick thoughts on that before we get to GDP, or just take us to GDP.
Well, yeah. One quick thought is, markets typically, don't react all that differently depending on who's in control of the White House or Congress. And I know you've got a lot of data on that. I bet we will probably end up doing a whole podcast on that at some point. But yeah, my general gist of the political environment is that the political environment doesn't impact markets all that much. It doesn't really matter who's in control of what, with the exception of the market seems to like it better when control is split, when one party doesn't have control of everything, and when you have more of an indecisive government body changing rules or not changing rules. The market seems to like it better when there's friction in Washington.
Yeah, yeah. I'll save going through the numbers, but it's safe to say whether we looked at combinations. I'll call it triple R, triple D. All Republican, all Democrat, and then mixes and matches. And the occurrences, some don't happen too much, but you know, I mean, generally the markets are up across the board. Um, so anyway, yeah, maybe we'll do that on another show, Jay. But GDP, take us there.
Yep, you got it. I come in relatively high on 4% GDP compared to the rest. Maybe I'm in the middle, but I'm at a 4% GDP change through Q3 of next year. It's going to take too long to wait for Q4. So from Q4 now, which is now, through Q3 of next year, I'm at about a 4%.
Yeah, you are. No, you aren't the highest. I think somebody was 4.5. I'm at 2.9. And so look, I mean, if we start to normalize, I say normalize. Let's say I'm right, and COVID's done by May 1st, and we just get back to, in general, though, if you look at the Obama years, the Trump years, and you go back even, you know, you'd have to go back to Clinton and Reagan to have the last time we were sort of, averaging, let's say 3.5% or something over a longer time. I mean, there have been times when they've reached those on 1 year, but so I don't know, Jay. I mean, 2.9 seemed like a good place to be, and it goes back to numerator denominator. I mean, GDP has already accelerated, so to get incremental growth, but I don't think your 4 is unreasonable. We could see more than that if this thing all ends. So I don't think you're too far off.
Yeah, I mean, if you get your previous pandemic kind of growth, maybe it's driven by maybe GDP goes along with it. I think if I could. By the way, on GDP, I'll add one other point to it. Nobody on the investment committee said we were going to have a recession next year, right? Which we all know is 2 consecutive quarters of negative growth. Maybe we all don't know that, but now we do. Nobody thought there was going to be a recession next year. Even the folks with the lowest GDP prediction still don't have us with negative growth for 2 consecutive quarters. So I thought I'd add that one in there. we don't think we have to expand too much more on that. But back to your point, right? For me, I line up, and while even my stock market level is a little lower than yours, I think I end up being a lot more bullish when it comes to GDP, when it comes to things like inflation in the 10 year, but and certainly earnings, right? So to me, it's they all kind of line up a little bit. Um, for you, I think you've got a little bit more of a mix there, probably more measured as we started out the conversation on where things are going to go. I and so I you know if I could just slightly touch on something you started a second ago, Derek, which was you said, and let's just say I'm right, and you expanded. Well, let's just say we're wrong, right? Let's for a minute say that all of the numbers, which are generally strong in all of these categories here, let's just say we're totally on the wrong side of this. Let's say there is a recession. Let's say we don't have the growth that we're talking about. Let's say earnings don't appreciate. Let's say that inflation really gets out of control and scares the bejesus out of the market, right? And really forces the Fed to get aggressive in cooling things down, right? Does it change the way that you're going to invest your clients or that we're going to invest and manage our strategies, right? Is it going to matter all that much in the approach you take to driving returns or at least investing for the goal of returns for your clients?
Not at all.
Yeah, I agree. Right. Thanks for that long explanation. So when you say no, sorry, I'm
No,
taking
no.
this your
You know
hosting
what?
job over here.
I was muted, I think. So I unmuted myself just to make sure. I said something else, but keep talking, keep going
I'm
on.
sorry. I'm just teasing you a little bit. Yeah. So yeah. So the point here that I'm making is while we are investing and we expect growth and I think we're following a lot of trends. While we don't mirror each other's predictions across the investment committee, they certainly do sound and smell the same for the most part. A lot of this is just it's conjecture, right? It's hey, look, we think there's a lot of positive reasons to remain invested and not go to cash and not put the cash in your mattress, right? And so as we're positioning our portfolios, we always take that perspective. Though, what if all of these things that I just said, or even one or two of them are just completely wrong and the exact opposite happens? I think we should plan for some of these to be completely wrong, right? There's no way we're going to get all of these things right. So does it? My question was, that maybe you could dig a little deeper on this is why doesn't it matter to the way that you build your portfolios for your clients? Like the way that you should be investing in this kind of environment?
Yeah, I mean, quick answer is in 1987 we had a market crash and we were down like 30% intra year, and the market closed up. I think it was a couple percent for the year. 2020 had a drawdown of 37%. We ended the year 2020 on the S&P, we were up 18%, I think, from memory.
You're
And
right. It
so,
was 18. Yep.
and I think that's the most obvious answer is I mean, the way we invest is having buffers or floors and, a hedge in a portfolio. If you can allow people to sleep a little better at night and not make panicked decisions, the reality is a lot of years, the worst points in the year don't wind up being the end point. Even 2008, I mean, we were down 55%. We ended the year down 37%. Guess what? That could happen again, up 37%. I have no idea it could happen again, right? But I think that's the main thing. And it's not timing. It doesn't change things. Because guess what? If we always just imagine we entered and exited markets just because of we thought it was going to go up or down, how whipsawed we'd be, how much we'd miss out on. And we've talked about that data in the past. So that's the longer answer, Jay.
Yeah, thanks, Derek, for that. And I would say those, swings and whipsaws that will occur for sure are happening in a more compressed time period today than even say I'll go back to 2009. Yes, there was a bunch of terrible days in 08 and 09, as we both remember, but uh, I think that the market, and this touches on the pandemic comment, the previous pandemic, is just faster today. Liquidity is a lot more dynamic. You've got a generation, multiple generations that are obviously able to pull the trigger quickly uh, uh, and enter and exit positions, at at the drop of a hat. And so, I think that the technology that we have provides liquidity and takes it away just as quickly. And so, I do think we see volatility, right? Volatility is not going away. We've got some predictions on volatility here. You and I both end up, in about the same range here of I've got a, high of the VIX at 35. You come in at a 40. For that to happen, you're going to have some shakeups in the market, right? To see those kinds of highs and lows. But staying invested over the long time, over the long term, being protected all makes a lot of sense regardless. And so if all of these predictions that we have are completely wrong, it doesn't really matter as much because you've got strategies that are designed to withstand this and not rely on, traditional allocation models.
By the way, Jay, I just saw this. You have a 4% positive GDP. I have a 2.9%. That's a difference of 1.1. Our difference in inflation outlook is 1.1. So remember, GDP is real GDP after inflation. So that's the difference in mine and yours forecast. I just realized that.
That is, yeah, that's interesting. Hey, we're close. We're close,
Yep.
right? We're consistent with each other, so that's great.
Yeah, VIX real quick. So yeah, I think I said it would be a high of 40. You said a high of 35. Mine is more that we're at a higher place anyway. We've been hovering around 20. So it's easier to get to 40 from 20 than it is to go from 11 to 40. You know what I mean? Or 20 to 40 versus 11 to 40, like we were in 2017. So, I mean, I don't know. All it takes is one big little sell off, and we could see that. But I think both of us agree that the VIX for 2022 will be elevated relative to what we saw 2017, 2018, where it was really low for the year. Wouldn't you agree?
Oh yeah, no. The data is definitely clear that we have entered a new period of higher volatility. Right, the market goes through these periods of like 3 to 4 years of high vol and low vol. You're right. 2017 was the low vol that we've seen ever since anybody was tracking the VIX. Um, uh, but that wasn't the end of it. Right, up all of there was a little bit of a spike in 2018, but volatility was pretty low in 17, 18, and 19. Of course, in 2020, it changed, and it's probably kicked us into another, 3 year period, 3 to 4 year period of higher volatility. And so, we're going to be going into the third year of that higher elevated, more elevated volatility. So, yeah, I think we just think it's the averages in general will be higher this year and possibly next year. And this is, just trends, right? Have told us that you're in these periods of high and low volatility. Right now, it's pretty obvious that we're in a period of higher volatility on average.
Jay, so we've got oil, we've got Bitcoin and gold. Oil, I think, and we're talking about West Texas Intermediate. So the one you see on CNBC. I'm at 55. You're at 75. Um, I mean, I guess I'm lower than we are right now. You're a little bit higher. You want to comment on this one, or?
The only one I'd say is, a little inconsistency where your inflation is at 5.1, but you're the lowest on oil, right? So, is inflation going to show itself in the commodity space or not? You're saying no. I'm kind of saying yes, right? But if we have demand that's pushing the market higher, my thoughts, oil demand will also go up.
This is one I think trying to put a pin in this and pick a number is I leave that for petroleum analysts. I mean, but I just kind of looked at it as if we get any sort of spike higher, this is, demand will come back into the market. Um, I think either of us are likely to be right. I think either of us could be wildly wrong, but
Yeah,
um,
dartboard for us on this one, right? Is it legislation, right? Is it the fewer wells you allow means it's harder to find more oil available? So does that push it higher, or is it, hey, we're really moving away, and EVs or electric vehicles are really going to take hold, and we're going to reduce demand in this country for oil, right? That's going to be an interesting year. That's the one I think we're probably, well, it's not the one we're most far away from each
no,
other.
no.
Let's save that one for last. But why don't you work on the gold next?
On gold, yeah. And by the way, with oil too, one of my thoughts was politicians like to get reelected, and so I think the Biden administration will soften on some of the regulation on the oil industry and they want more supply to come in because a good way not to get reelected is really high gas prices. But gold, yeah, I was at 1,700, right around where we are now, I think, right? I'll have to look it up.
We're at
I don't know.
1800
On this
right now
side,
there.
it's eight, yeah, and you're 1950, so you're a little higher, a
We're
little lower,
straddling
but
that.
yeah, I don't know. I mean, I just feel like gold is lost. This is my opinion, and it's probably wrong, but I think people are hedging inflation in different ways now, and they're hedging the market in different ways. But I mean, yeah, I don't
Yeah,
know.
I agree. Gold is not the inflation hedge that it used to be. If it was, we should be at 2,500 an ounce, right?
Agreed.
But we're not, right? We were at all time, not all time highs. We were very high, recent highs when it comes to inflation. And gold is like, meh, I'm going to stay range bound. For me, it was actually a demand driven improvement, right? I think if the economy's good, I think there's more purchases of jewelry. I think it's not so much of a hedge. I think it's actually more demand on goods made with gold. And I know there's not a lot of industrial or any industrials products that are made with gold. It's really more of a luxury item. So, to me, higher, better economy, better growth, better inflation, it kind of pushes it up a little bit. You're on the other side of this. By the way, the average was all over the place in the investment committee for this one, right? Our average, we came in at 1,700, which is right, but we've got people as low as 1,500, right? I ended up being the high water mark at 1,900. So who knows?
You were. And our last one, Jay, is Bitcoin. I'm going to let you take this one, but remember, those regular listeners will know that I'm a little more the Bitcoin skeptic. At least when we've debated it on air, I've taken that position. You've taken the other. So, what are you seeing here? Because we are far apart.
Oh yeah, well, this is the one we are the most far apart, and I would say you're probably most far apart from everybody else in the investment committee. I'm at 85,000 by the end of next year. Reason being is when you take a look back to 2014 and you look at how Bitcoin has had this volatile and extremely large run. If at any given time you took a look at, a day, the price of Bitcoin on any single day, and you look back, 12 months, you look back exactly 1 year. If you looked at that, period, the last 7 years, half the time Bitcoin is up by more than 100%. So you pick any day from 2015 to today, and you look back 12 months, Bitcoin is up at least 100% half of the days that you look back. And so to me, it's an asset that maybe I'm going to get criticized for calling Bitcoin an asset, but it's a token that has shown a propensity to grow over time, right? So that's where I am with it. Why don't you explain where you are, Derek?
Yeah, I mean, I continue. I think the fact that Bitcoin has not done well in the near term, as we've had higher and higher inflation, is going to make some people question whether it's an actual inflation hedge. And neither you and I both said it hasn't been long, around the block long enough to really know if it is an inflation hedge. It wasn't around in the 70s, in the early 80s. So yeah, and the other thing I keep going back to, I feel like there's so many different coins that are being launched. It's taking a little bit of I don't know. It's spreading it a little more thin in the crypto market. And I could be totally wrong. But I also think that there's going to be increased government regulation. You hear more about central banks wanting their own currency so I don't know. I mean, I think there's
Give
so
them your
much
number, man.
bullishness on this. Oh, I was 38,000. Yeah.
There you
So
go.
I'm
38,000.
I'm lower. But I just feel like there's so much bullish on this and people who have been bullish have been right for a long time and you can't be right for forever. So, but Jay, I have no idea, honestly. I just don't.
who
I
who
mean,
does? There's so many factors that could impact the price of any of the cryptos, right? It really is it's anyone's guess, right? So much I could apply logic to each side of it. There's a lot of folks that still have yet to even dip their toe into Bitcoin because they don't understand what it even is. And you know what? That's okay. Then you don't have to be involved in it. But we just thought it's such a hot topic. Almost every interview that I've done, somebody wants to know our take on crypto. even though we don't do any crypto trading at Zega today. It's just something, it's such a hot topic. Everybody wants to hear our opinion on it. So we thought, put it in our predictions. It would almost be, remiss and deliberate for us not to include it. And I think everybody appreciates and enjoys that you and I are literally on opposite sides of the coin. What do you think?
Yeah, and we didn't mention NFTs, by the way. Maybe I'll take the raw recording of this, like the MP4 or MP3, I forget what it is, of you and I's podcast today, and offer it up as an NFT and auction it off for $1 million. I am an NFT skeptic, but that's for another time, I suppose.
Yeah, let's leave the non-fungible tokens out of it for now. It's a whole nother, I'm actually on the same page as you when it comes to NFTs, but it's a thing. But I also don't own a lot of fine art, so I'm just the wrong person to think about that.
Yeah, maybe so. I think if we look at this, though, we look at our 2022, it's to kind of think about everything we said. Number one is neither of us see a recession. And I'm not saying that we won't see one quarter that goes negative, but I don't foresee, unless we did lockdowns again, that we would have a really negative recession. I imagine it's possible we'll have a slightly negative quarter. I don't think we'll get two in a row, though. But yeah, I think you and I are both generally bullish. I think we're not, the thing that's interesting is even though we're different on rates, I'm 1.47, you're 2.5 into your 10-year treasury. Guess what? If it's 2.5, that's still really low on a historical basis, Jay. I mean, and our market is sort of the average. We're a little bit boring here. We're both like, hey, we think it's going to go up about the average, right? So,
Right,
yeah.
right. There you go. We're really going out on a limb here, and so I'm sure it'll be interesting to see which one of these is completely wrong, right, and how it impacts the other ones on this list that we've just talked about. But you're right. Even at 2.5%, you're still probably less. You still probably have a negative a negative real rate against inflation. So it doesn't really change our philosophy about investing. I will say one other thing about it, and I haven't been asked this a few times, and so I'll bring it up. We are believers that in an inflationary environment, stocks tend to do better than most other asset classes. And I'm going to include gold in there because when you could take a look at the return of equities, and if they're driven by corporate earnings, historically speaking, stocks on a inflation adjusted basis have outperformed during periods of higher inflation. So we like them.
Yeah, no, I agree there. And I think the data shows that. Professor Jeremy Siegel, who wrote the book Stocks for the Long Run, he's got a chart I don't think he's done an update since 2016. He ought to do a new one. But he's got that chart, real returns. And I think he goes back to the early 1800s. So he's going beyond like the Cowles data and what Ibbotson collected and all that stuff. But he basically shows that stocks, I think, over the long run, have a real return of something like 5 or 6%. That's after inflation. I'm doing this from memory, Jay. So if I'm wrong, the viewers can or listeners can send me emails. But when you look at gold, you look at the dollar, and you look at bonds, gold specifically has really over the long run a lousy after inflation return. So you're right. I mean, and the data's out there that stocks have done quite well in inflationary periods. It's kind of interesting.
Yep. That's what we think. And guess what? And then you pull some of the volatility out as we're projecting that, the markets are going to have some, we're in a period of higher volatility. So you do that by hedging and putting buffers in your portfolios. Like these are the ways, this is kind of the new way of investing and from our perspective, right? This is why, we construct portfolios with options that allow us to define our risk. So, while I feel like I'm on a soapbox here. That wasn't my intention. But, when you give predictions, the natural next question is, okay, well, then how do you invest in that environment? And our answer is exactly the way we've been investing for the last decade at Zega Financial, and the way you've been managing your clients, Derek. It's, continue to be invested, but be invested for the long term, but be hedged.
I think that's a great place to close, Jay. So this will be the last episode for everyone for 2021. This will, by the time you're listening to this, will probably be December 26th or 27th. But this is, and then you can, December of 2022, you can re-listen to this one and see how bad we've done, how wrong we actually are. So Jay, thanks for coming on, and hopefully we'll have you back for maybe episode 150 or something. You seem to miss the round numbers though.
That's all right. Congratulations on such a great year with the podcast, Derek. You've impressed us all. So keep up the great work. Just glad to be a part of it.
Appreciate it, Jay. And for everyone else, we'll talk to you in the new year.